exchange traded funds, one of the top questions we get asked is, what is an exchange traded fund and should I be owning those? Well, in today's video, we are going to cover two key topics. One, what is an exchange traded fund? And two, why are they beneficial in becoming more and more popular? So let's go ahead and dive into this video. If we haven't already had a chance to meet, my name is Luke Turner. I'm the co-founder of Mo Private Wealth. We help athletes and entrepreneurs get smarter with their money. We're going to be putting out more and more content around financial topics just like this one. If you haven't already, don't forget to subscribe to the channel below. Let's dive in. First, what is an exchange traded fund or ETF? So let's look at a basic scenario here. An exchange traded fund is a way for you to buy one individual position, and by owning that one position, you own a collective of individual stocks. So let's look at one of the most common ETFs that are out there in the marketplace. It is SPY or SPY, which stands for the S&P 500 index. So when you buy SPY, what does that mean? Well, what it means is that by buying that one individual position, you are going to own all 500 of the largest US stocks in the United States. So it's a very simple, easy way for you to get a diversified portfolio and own one individual position by doing it. Also, when we think about an ETF, one of the biggest questions we get asked is, well, what's the difference between an exchange traded fund and a mutual fund? Because a lot of us have heard of this mutual fund conversation. Those have been around for a very, very long time, going back decades, whereas exchange traded funds are a little bit newer. And let's look at some of the main differences. So main difference number one is going to be that an exchange traded fund is traded on a daily basis. So if you go into your brokerage account and you go try to buy SPY and you buy one share and you click buy now, that is going to show up in your account immediately. And no matter what happens with SPY, you're going to see the fluctuations up and down in that. Whereas a mutual fund, those trade at the end of the day, which means that at the end of the day, if you go to buy one share of a mutual fund, that position is only going to show up in your account the next morning. So if you buy that position at noon today, no matter what happens in the market up and down, that is not going to be reflected until after you own the shares, after the stock market closes for the day. And then when it reopens in the morning, that position is going to show in your account. So that's one big difference, is that the exchange traded fund is traded intraday, is what that's called. And the mutual funds are what are called open-ended funds, where every time you buy them, new shares are issued. So the second big thing that we need to be thinking about from a difference between an exchange traded fund and a mutual fund is that an exchange traded fund is much more tax efficient. Now, why is this? So an exchange traded fund uses something called the custom basket rule. We're not going to dive into the weeds of it. If you want to Google it, feel free to Google it. It's a pretty complex topic, but an exchange traded fund allows us to be very tax efficient because no matter what happens inside of that exchange traded fund, if it's managed properly, at the end of the year, you are not going to get what's called a capital gain distribution. For example, let's go back to our S&P 500 example. One of the new stocks that entered the S&P 500 earlier this year is Palantir, which is a very large tech company that entered the S&P 500. Well, when a company enters the S&P 500, they need to buy shares of that company. And then when a company exits it, they need to sell all those shares. Okay, so there's this event that's occurring that you would think would trigger some sort of capital gain, but it doesn't. In an exchange traded fund, even though that transaction happened, due to this new rule called the custom basket rule, there is no taxes that are going to get distributed out to you as a shareholder. So it's a really important key element, is that exchange traded funds are very tax efficient. Whereas a mutual fund, on the other hand, if that same situation happens, you're going to get what's called a capital gain distribution at the end of the year, which is going to be much less tax efficient. Then the third thing that we need to look at on an ETF and why it's important to understand this is that an exchange traded fund are typically a much more lower cost option. There's something called an internal expense ratio in an exchange traded fund or ETF. Typically, these are very low, somewhere between 5 basis points or 50 basis points, typically in that range. And when we look at that, what this is an internal cost to actually manage the fund and manage the operations behind the scenes. Typically, there is a much lower cost associated with the exchange traded fund versus a mutual fund. So what should you take away from this video as it relates to exchange traded funds? A couple of things. And the most important is that from a diversification perspective, an ETF is a great way for a beginner to get started in looking at investing into stocks, but not taking on too much risk. Because by buying an exchange traded fund, it typically allows you to diversify the portfolio and be in a position that you're not going to experience huge swings up and down which you might experience if you go out and you buy individual stocks. Again, if you have not subscribed to the channel yet, please subscribe below. If you want to learn more about how I'm investing my own money and how we recommend investing money for beginners, please check out the video in the description below where we cover everything as it relates to how to invest for beginners.